So let's go through the everything code. The everything code is the overall thesis of my understanding of how we got to where we are today, where we're going, and how it all comes together. I've said before, everything is demographics. The labor force participation rate is a representation of the demographics in the US economy. The US is better than others. Europe has worse demographics, Japan worse, China worse. But this is what drives economies, inflation, and it also drives government debt. As the population ages out, this chart is one that I'm surprised that nobody's copied from us and is probably the single most important chart in all of macro. Government debt is a function of aging populations. It is there to paste over the cracks. If you remember, GDP growth equals population growth plus productivity growth plus debt growth. Debt growth is the part that is papering over GDP growth. It is filling in the cracks. It is very important that you all understand this. But as debt to GDP increases, it becomes harder and harder to figure out how to finance it. So what comes along is the use of liquidity. Now, we've used Fed net liquidity here. We'll talk about total liquidity later. The governments have shifted, the central banks and governments have shifted from originally balance sheet use back in 2008 when everything blew up till about Draghi and just after that period. Then they started using net liquidity. That's when you use the Treasury General Account. That's when you use the reverse repo. So you're bringing in the private sector into this and the government balance sheet, not just the central bank balance sheet. And in recent times, they've moved beyond that to use total liquidity, which includes the banking sector. But basically, all liquidity is there is to service the government debt. This chart is incredibly important for you to understand. So zooming in where we are today, you can see that US total liquidity, so that includes the banking sector now, which is the new mechanism by which they're absorbing the debts and mandating banks to hold more government bonds. You can see it follows this debt to GDP chart. And here's the chart that drove the everything code. This is the interest payments going forwards. And here is liquidity rising to meet it. This is how you service the massive debts. You pay the interest. You do it via currency debasement. That's what liquidity is. It's a fancy word for currency debasement. And total liquidity is the way that they've been doing it. Now, this is not new. This was all done after World War II, when at the same time the world was massively in debt. We had lost a large part of the working population via war. And we then had to erode the debt via financial repression. Financial repression is when you keep yields lower than growth or lower than inflation, but generally lower than growth, nominal growth. And what happens is that over time, GDP rises, but debt doesn't rise as fast as GDP, and you erode away the debt. And that's via debasement. So that was very common in the 1950s. That lasted about 2 decades. We're about, where are we now? 2008. We're almost 2 decades into this episode. And interestingly enough, the S&P now very much follows the S&P in the 1950s. And what we had then was the everything code as well. We had this perfect 4-year cyclicality that plays out very similar to the cyclicality now. That cyclicality is the debt refinancing cycle. So in this stupidly colorful chart that nobody can read, and if you're colorblind, you're totally fucked. But imagine you could see it. You can see all of these colors, and basically each color is a year. And in liquidity terms, these are broken into seasons. So we're currently coming into the fall season, or autumn if you're not an American, because fall sounds stupid, because what leaves fall or something, I don't know. But anyway, the autumnal season, and it's the nice autumnal color on the chart if you're not colorblind, is when you tend to see the main debts roll. So we've got about 9 or 10 trillion of debts to roll this year, and you need a large increase in liquidity. The last cycle, 2020, most of the liquidity actually came earlier because of COVID. But generally speaking, the liquidity cycle is this year. So we're expecting an expansion of liquidity. Now, there's various proxies for liquidity. Global liquidity is the important one, but it lags global M2, which is a faster reported series. Global M2 is driven a lot by the dollar, plus all of the private sectors and the government sectors around the world. So we found that these two have been really what matters. So when we think, now these are global numbers, everyone gets confused. The Fed are going to cut rates. It's irrelevant. It's irrelevant. It's this global liquidity that pays the global debts. Don't forget, 50% of the entire world's debts are in US dollars. That's one of the things that Scott Bessent has been talking about. Steve Merrin's ideas are about, is trying to reduce that. Good luck to that, but that's what it is. And it's the global cycle. So we know that the dollar is weakening. We'll talk about that later. That's a big part of this. We know that interest rates are coming lower, which is part of global liquidity and also part of financial conditions. We know that the US has been using a drawdown in the reverse repo and the Treasury general account. It will rebuild because of tax season coming now, but generally the US is injecting liquidity. It will not use the balance sheet yet, but it may well do later in the cycle. We need to see. But where the big game is to be played is China. China's balance sheet lags China bond yields. So if you remember, the US said, well, we won't ever get to QE until our bond yields get close to zero. Well, that's happening in China right now. They're in a full debt deflation. And China's going to be very important to this story. And it's the most important headline that is going to come is what the agreement is with China. So the agreement with China will be, and I've been talking about this for a year in Global Macro Investor and Real Vision Pro Macro, the agreement with China will be, you will agree to tariff terms. We will battle it out in public and make us look like we're all strongmen. You will agree terms because you have a dollar debt problem. The Chinese have a dollar debt problem and they need to service those debts. The problem is the RMB is too weak and the dollar is too strong. They don't have the cash flows in a slow economic environment to pay for it. They know, the US knows, Yellen even went to talk to them about it when she was still at the Treasury. They need a weaker dollar. Now, the mechanism by which China gets access to those dollars is usually via the euro-dollar market, and it's Japan that is the big driver of the euro-dollar market. So when we look at the weakening of the dollar, I like to focus on dollar-yen to think of how this plays out. The yen is one of the world's big exporting economies, and it has a very weak currency. The yen needs to strengthen, and a strengthening yen and a weakening dollar will allow capital to flow into China and other dollar borrowers via the euro-dollar market. And the key thing that happens here is this chart of the Chinese currency against the yen. The Chinese currency was too strong versus the yen, and that has been putting pressure on Chinese exporters and the Chinese economy. It needs to rebalance lower, and this head and shoulders top and this head and shoulders top tell us the US, Scott Bessent, is going to get what he wants, which is a weaker dollar. A weaker dollar will stimulate global demand. It stimulates and allows for the rolling of global US dollar debts. It allows for exports and imports to free up. It allows for the movement of trade, even with tariffs. It's a very big deal, the dollar weakening. And if China can have a weakening yuan, a strengthening yuan, a weakening yuan against the yen, what it allows them to do is to compete. And that rebalances global trade and gets the global growth cycle going. So China headline risk to the positive side is the big one. Everything else is kind of noise because this is the big rebalancing that the world kind of wants. Everyone has a trade-off here and everybody will come to the table for a trade-off, even China. But of course, everybody needs to look like a tough guy in negotiations, but something will happen and we will rebalance and we can move forward. This is exactly what happened last time when Trump was in power in 2017. What we had was called the Shanghai Accord. It was a kind of public, not public agreement to weaken the dollar to allow the Chinese to stimulate, because they need a weaker dollar to stimulate because they don't want to weaken their currency via the currency band, because if not, you get a devaluation, which they do not want. So that was the Shanghai Accord then. The dollar fell dramatically and the Chinese stimulated massively. If you remember 2017, the Fed were raising rates. They were shrinking the balance sheet, but China and Europe stimulated. And that was via this mechanism. So this time around, we've got the Mar-a-Lago Accord, which is some generalized understanding that an agreement. But now I'm going to hand over to Julian. So hopefully I've covered most things, Julian, unless there's anything else you think I haven't covered so far, the big picture.
No, I think that was a good summary. And again, most importantly, just China, 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 right? As opposed to when's the Fed going to cut kind of story.
Yeah, the Fed cut is such a red herring, because that's delayed versus actual liquidity, actual financial conditions. The financial conditions are the key thing. And you'll go through that, because financial conditions have been easing so fast that it sets you up for something incredibly bullish, which is, I know it's hard, because people today trade the fucking headlines. And what they should be trading is what happened 3 months ago. And they don't understand this lead and lag between what drives markets and markets themselves. So everyone creates false narratives around stuff. Anyway, we'll talk about that as you go through your bit. So let's go through your bit.
Yeah, nothing changes sentiment like price, right?
Yeah. Or narrative like price. Everyone's narrative fits.
What we had been writing about in Q4 when we started to address the outlook was the fact that financial conditions were tightening very quickly. And on X, I even wrote quite a long thread about the dollar wrecking ball. And that's really what we're feeling now within the data and markets, which we'll go through in this presentation. But when you look at this, so this is the dollar and bond yields, right? Inverted, so the teal line, and advanced by 2 months versus the US Economic Surprise Index relative to G10. So we've seen US data coming in below consensus expectations and below that relative to what we've seen globally, meaning that the US has weakened disproportionately faster.
Because the dollar has been too strong and rates have been too high, or they were in the past.
Correct. And so we saw it, that was the back half of, by the way, the back half of 2024 was a very positive environment for risk taking. And here we are again, now that the dollar and rates are coming down so fast, setting the stage for an environment where we believe growth momentum will start to bottom and turn higher. And we'll talk all about this more in a second. But what's also important, and Raul alluded to this back in the 2016, 2017 cycles, we saw exactly the same thing. What happened with the dollar and rates moving higher in Q4 of 2016, much like we saw in Q4 of last year, was the market actually speculated that much like Trump version 1.0, Trump 2.0, tariffs would be inflationary. And as a result of tariffs being inflationary, that drove rates higher. So that drove bond yields higher, that drove the dollar higher, and that drove inflation break-even rates, something we'll also talk about higher.
Which actually set up conditions for a disinflationary environment as opposed to what they feared, which is funny.
That's right. But the point is that all stopped and in the middle of 2017, and this has already reversed, as I just pointed out. And this is why this is old data. I'm going to show you the updated data, the updated chart on this in a second. But essentially, this is what drove the dollar strength, in particular in Q4, is what drove a lot of the data weaker. So what we saw is, if we look at the market U.S. services PMI, and I'm focused on this chart, and I talk about it all the time because this is a chart a lot of people were focusing on when it fell to 49.7 in February and was saying a recession is on the cards. And both Raul and I were like, no. And this data has since reversed higher. I'm going to show you the updated version in a moment. But this chart, this next chart, really summarizes really what's just happened. What's happened is that because markets are generally priced off of consensus expectations, the minute data starts to come in below consensus expectations, the opposite is also true, right? When economic surprises are rising, the market needs to reprice that. So what's happened if we look at risk assets, so here we're looking at Bitcoin, but it's the same chart if we look at the NASDAQ. So this is the quarterly change in Bitcoin prices. We've had to price in data coming in weaker than consensus expectations. And we've actually overpriced that, which is what you can see now. So again, our view has been that this is a soft patch, something we were talking about in Q4 of last year, and not a recession.
You've been flagging this economic weakness in Q1 all the way back in October, November of last year.
Correct.
Saying that Q1 is going to be weak and it's going to set the Fed up potentially to cut rates. All sorts of things are going to happen. The economic data has been weakening, and this is playing out as we've talked about.
That's right. And so the GMI Financial Conditions Index is a regression on commodity prices or certain commodity prices, certain bond yields and the dollar. Okay. And what you can see here, once again, is that this is what's been driving growth weaker in Q1, but now on the basis that, inflation or tariffs are, well, they were inflationary, but now the market's obviously reversing that narrative. Dollars lower, which was, again, one of our base cases heading into this year, something we'll talk about also a little bit later. Rates lower and commodity prices lower is now goosing our financial conditions index. So it's moving a lot higher, which again is setting the framework or the groundwork for economic data to start coming in above consensus expectations. Now, I said back in mid-March that the economic surprises would bottom in mid-March, and that's currently seems to be the case, and this will become more evident as we...
But they won't start accelerating until May. So we'll have softish data and a nice backdrop for the Fed to cut.
Yeah, it's not the point. It's not going to happen so fast that all of a sudden the Fed's going to back off. That's for sure.
No.
But they're still going to rise.
Fed cutting is good for Main Street, not Wall Street particularly. It doesn't really make a difference because Wall Street trades off financial conditions.
Correct. And then when we look to the extent at which, and this is the chart I had shared on social yesterday, right, to the extent that, Bitcoin prices have not only already priced in a lot of the weakness in the Citi Economic Surprise Index, it's fully discounted the Q4 tightening in financial conditions that we had been talking about.
Now, remember, Julian, we were using this chart that got us the exact low in the October, November, December period in 2022. It was the financial conditions that we've used as our key indicator for the key reversals in narrative and price.
Yeah, that's right. And I don't remember if it was September or November, but we wrote the GMI article, "The Turn is Near," and charts like this one featured in there. So this was a big basis for that. So we know that this works, is the point. The other thing is that I can see a lot of people talking about, the widening in junk spreads, so credit spreads, and that being the result of, Trump's tariff announcements last week. I mean, that's true and not true. It actually is the result of the market speculating that tariffs were inflationary, which all happened in Q4, which tightened financial conditions, which started to drive credit spreads higher. So credit spreads have actually been widening, much like the Citi Economic Surprise Index has been slowing over the entire since the beginning of the year. Now, last week, credit spreads obviously jumped a little bit more, I think by 20, 30 basis points on the fact that the VIX is spiking and equities are selling off. But the reality is that credit spreads are widening because of everything that happened in Q4 of last year. The market reaction to last week's statement is more of an overreaction, but really what's gone on, which I'll show to you later, but really this is all a symptom of tighter financial conditions in Q4, which is now reversing. Now, I said I would show you the updated version of this chart. So at 49.7 back in Feb, people were saying, well, it's a recession. We were saying, well, financial conditions are now easing so quickly, this data would improve over the next 1 to 2 months. And we just got this data last week, and we saw the services PMI jump to 54.4. Okay, so improving and not a recession in our view. And then the next thing, I'm just going to say is that, I don't expect the white line to go higher in a straight line. But if we look at the OECD data, so this is their leading indicators. We look at the percentage of countries rising month on month. So this would be a measure of global economic breadth. The fact that financial conditions are like our daily real-time proxy for this kind of metric, and that it's moving higher so quickly now that the dollar and rates are dropping and commodity prices, this will goose lead indicators in the future, right? So we're in an environment where growth momentum should now begin to improve after we spent the last 3 months decelerating, okay? So next thing I want to talk about is the business cycle. Now, just because this is also being released on YouTube, I'm going to talk about the ISM. And so the ISM stands for Institute of Supply Management. It's basically a monthly survey that goes out to supply chain executives and asks them about new orders, so what they're expecting on growth. It asks them questions about employment, price pressure composites. So are prices rising or are they falling? And it basically creates a diffusion index, which looks like this. So the white line. So anything above 50 means that we're gaining momentum, and anything below 50 means that it's slowing. And what we saw in the latest report in March was that it worked a little bit lower, and that new orders fell rather considerably. But once again, this is a mix of liquidity and some other credit-based leads. But you can see that really, once again, this was just the result of tighter financial conditions in Q4, which drove new orders lower. So by the time we get to, let's say, April, May data, we should see new orders start to improve, right, and start to rise again, as opposed to going to sub 40, sub 30, or not maybe sub 30, but heading into recession. And what's also important is not only are lead indicators starting to improve on the basis that financial conditions have eased over the last 3 months, but you can see here, if we're talking about Bitcoin pricing, we've already priced in a slowdown to around 47, okay? So it's already in the price. And then when we look at this famous chart, if we look at new orders less inventories, this is largely a one-off. If we talk about the spike in inventories, obviously front-running tariffs, right? But this is also, if we look at cyclicals versus defensives, it's already fully in the price, right? And then when we scratch the hood and you look at the number of industries reporting growth from 1 month to the next, last month we were at 10, today we're at 9. So it was hardly as bad a report as people had speculated. And from here's the really important bit, is that if you look at financial conditions, and this is precisely what Raul was talking about just a second ago in Q4 of 2022, when we had written our article, The Turn is Near, we were looking at an environment where financial conditions started to ease very rapidly. And here it's advanced by 9 months and currently suggests that we'll end the year, just above the mid 50s. Currently it's suggesting 57.
And from what we think, Julian, looking at the structure of the business cycle, this and our expectations of a weaker dollar and lower rates and potentially lower oil prices, this should actually extend further. So we should see a full ISM cycle above 60, probably into Q1, which is one of our ideas, not yet confirmed, about an extended cycle. So we should see the business cycle be strong all year.
Yeah. And I think also, and that's a good point, because the thing to keep in mind here is that financial conditions are advanced by 9 months. And so earlier in the year, we were asked, well, does the cycle end in Q4 or does it extend? But because this is already advanced by 9 months, this pushes us into late Q4. And if we're in an environment where the Trump cycle is repeating, which is something I'll talk about in another section a little bit later, then all of a sudden, if we're in an environment where the dollar weakens or at least trends lower over the course of the next 3 to 6 months, that's all of a sudden going to push this teal line out even further. So what I've always said is that the more financial conditions ease today, so the more the dollar drops today, rates go lower, so on and so forth, the more the business cycle can extend tomorrow. And tomorrow, I mean, Q1 of next year. And then, what I always like in lead indicators is when you take two completely separate approaches, and they arrive at a similar conclusion. So if we just get back to the GMI Financial Conditions Index, it was pointing to something around 57.8. And then if we look at another one of our lead indicators, which is basically one of our internal growth scores, coupled with the percentage of central banks who are cutting rates, because it takes time for changes in interest rates to impact the real economy. So here we're also forward by 9 months. This would suggest once again that we should be focused on the ISM moving higher from here as we progress through the year and not lower. So
but it's weird because the market narrative is tariffs are going to lead to recession. Can't you see? These guys are morons. What we do not see is any evidence of that within our forward-looking data, which should be pricing this stuff in, but is not pricing in a recession.
Yeah, but again, I think it's really, people are confused by, the market had speculated on, not quite recession, but the dollar rallied, which typically happens in, kind of a risk-off environment. Bond yields tightened, so financial conditions were tightening on both ends. But this was all because we were pricing in the fact that tariffs were inflationary in Q4 of last year, which is now what's driving growth lower. So we already kind of priced that in, if you see what I mean.
Exactly.
And then what we know is that it's really these periods. So currently the ISM's back below 50, but once we cross above 50, okay, and we trend into our late cycle peak, which is typically above, or let's say around 60. And as I just pointed out before, our lead indicators are already suggesting that we're going to approach those levels. That this is typically where we see the big moves, in Bitcoin and other risk assets more generally. But if we just look at the 2016, 2017 cycle, because we're going to zoom in on this in a second, you'll look at that white line in Bitcoin between those two, kind of the gray bar and the pink bar. So the ISM crosses 50 to the ISM peak and be like, wow, that looks like a straight line higher. Well, no, I mean, over that entire period, there was multiple 40% corrections, multiple 30% corrections, multiple 20% corrections. So that's why in the beginning, when Raoul said, these are our rules for engagement, they absolutely are. 35% corrections are the norm, and you just have to get used to that. As we've kind of always been saying, is that crazy volatility is the price you pay for crazy returns. So you just kind of got to let that sink in. And then as the business cycle accelerates, this is typically when we see alt season, right? So we see altcoins starting to gain market share versus Bitcoin. And this operates, you can pretty much plot anything versus the ISM, which is something both Raoul and I have been doing for a number of years. But you could take commodity prices, like copper, copper gold, oil prices. You can take credit spreads. You can take small cap versus large cap
emerging
equities, emerging markets. It's all the same thing. The point being is that as the ISM rises, you get more earnings. Confidence starts to improve. As confidence starts to improve, that means that people reach further out the risk curve, and that applies to small cap versus large cap equities. You see, it applies to like value over growth. Yeah. So anyway, the point being is that this is, for alt season to happen, we need to see the ISM rise, which is what we're expecting. So people reaching further out what we call the crypto risk curve, much as they do. And then if we look at, crypto total market cap, excluding Bitcoin and ETH, all that's happened so far, although it's all that's happened, it's felt, brutal, as we've come back to retest the breakout of what I think is a larger wedge pattern. And so this just all feels, and Bitcoin, by the way, has just come back to retest a larger inverse head and shoulders pattern, which is something that Raoul and I had talked about.
This is basically also the same as global M2.
And then let's talk about, I had mentioned this, let's talk about the Trump 2017 cycle is repeating. So this is a chart that we had shared in Q4 of last year. Raoul and I had, for some time, been noticing the similarities between Q4 2016 and the dollar strength that we saw, obviously in Q4 of last year. And this chart, it's just been working so well. And then obviously we switched gears in our annual outlook, talking about an environment where the dollar would weaken, and not only weaken, because what's funny about the dollar is actually over the last 2 years, it hasn't really done anything. It's just done this. And that's directionally, that's quite bizarre for the dollar. And what that's meant, obviously, is that the business cycle really cannot pick up. And these are charts I didn't include in here, but if you look at the ISM over that same time period, you'll see that the ISM has done this. Liquidity's also done this. So if the dollar actually trends lower over the course of this year, very similar to as it did in 2017, then that creates an environment where all of a sudden financial conditions are easing so rapidly that growth can start to pick up. And as Raoul had mentioned, Scott Bessent wants this, JD Vance has talked about this, Trump has talked about this. Trump understands the implication of a strong dollar, right? It suppresses exports, it hurts corporate earnings, and generally, as I just mentioned, it keeps the business cycle sluggish.
And that's a key thing. I put a tweet about this is, look, Scott Bessent is a macro hedge fund manager.
Yeah.
He understands how liquidity drives markets, what drives liquidity, and he understands his three pillars are the dollar, oil, and rates. Yeah. What are the three pillars of our financial conditions index? The dollar, oil, and rates. He's also talked about the everything code in the element of what they're trying to do is get rates below nominal GDP growth, which is financial repression and the way to service the debts. So he understands the big picture. Obviously, I've known him for 20 years or so, but It is very interesting when you've got a macro hedge fund manager running the show because he understands these things.
Yeah, totally. So again, we still stick to our guns that it won't be a straight line lower, very similar to what we saw in 2017, but the dollar should work lower over the course of this year. And as this is happening, because as Raul had mentioned earlier, a lot of the move in global M2 is driven by the dollar. Global M2, of course, is also mirroring the Trump 2017 cycle perfectly. Okay. Now, when we look at our total measure, which Raul had talked about earlier, which is both public and private sources of liquidity, we had said really all along that we were going to retest kind of the breakout zone here before pushing higher. And
which is the same as that, the market cap minus Bitcoin and ETH.
Correct.
It's the same chart. It just leads it a little bit.
It's kind of all the same chart.
It's all the same chart. It's all the same thing. It's all liquidity. It's all liquidity.
And coming to that point of it's all liquidity, if this is right, okay, we know that our GMI total liquidity index versus Bitcoin has an R squared of around 89%. Okay. And then for the NASDAQ, it's 95%. So of course, the business cycle and liquidity are the two most important driver of risk assets. And if we're right on the basis that China will stimulate, Europe will stimulate, and the Fed will stimulate this year, in 2017, as Raul mentioned earlier, we only really had China and the ECB. The Fed was actually withdrawing liquidity. Then this is an environment where you want to be invested. Okay. Now, the only other thing I'm going to say to the 2017 cycle is that tariffs are more aggressive this time around, and also Trump didn't put in tariffs into effect until 2018. But over his entire term, CPI averaged 1.9%. Core fell the entire time, and inflation break-even rates, if we talk about the 1 year, rallied in Q4 of 2016 and peaked in March of 2017, that same year. And what I had said in the MIT reports is that based on the fact that U.S. trueflation numbers had been collapsing, which I'm going to explain in a second why that's happened, that break-even rates would start to come lower. And once the VIX stabilizes, something we'll talk about in a second, so volatility starts to come down, falling 1 year inflation break-even rates is a good sign, because what it basically means is that there's less hedging going on in the real economy because there's less need for inflation protection. And as a result of that is that will unlock a pool of capital, which can then be invested, used for risk taking, used for hiring, used for CapEx or whatever. So I can see a lot of people saying, oh, well, Trump broke the business cycle and this and that, and therefore, inflation's going lower. No, trueflation numbers are lower because of what happened in Q4. Again, because rates were rising, the dollar was rising, right? Commodity prices were rising, that tightened financial conditions. And as a result of that, that not only slowed growth, but of course it slowed inflation, which is why we've seen these trueflation numbers coming down so quickly. And here our financial conditions index is advanced by 4 months. So what's the expectation here? Trueflation numbers probably base around these levels, maybe 1 to 2 months from now, whatever that is. These numbers lead the CPI numbers by, another 1 to 2 months. And so we had said that CPI heading into this year, that inflation metrics would fall, further. And that if anything, the second half of the year would be where we would start to see signs of inflation. But
only in the headline, right? Because the core is
correct.
Lagged because of rents.
That's right.
And as the Fed cut rates, mortgages come down, which affects owner equivalent rents. And so the whole cycling core lags.
That's right. So core should continue lower for the entire year. The only reason that the trueflation numbers would start to rise would be particularly in kind of the core goods segment of inflation, which is a function of the business cycle and rising commodity prices. And what we're seeing right now is the opposite. But the point being is once the ISM rises to the mid 55s or so, that's when you start to take inflation seriously, or the idea of that inflation will come back, because the business cycle drives inflation and not the other way around, right? And so this is not something the Fed that we should be worried about. When the Fed's always late to cut and they're always late to hike. When you want to worry about the Fed and a more hawkish stance, so starting a a rate hiking cycle is typically when services inflation, which is what Raul just talked about, starts to rise, which is a function of unit wage costs. So wages rising later in the cycle. And that's just nowhere to be seen in our lead indicators for the time being. So again, just wanted to point that out. So this is what we're seeing in inflation currently and Trump breaking the business cycle. Trump didn't break the business cycle. He's created this slowdown, but it has nothing to do with what's happened this year. It has everything to do with what happened last year.
Even Scott Bessent said the things you're worried about now, you won't be worried about soon, because he knows that financial conditions are easing so fast.
Yeah.
I mean, this is a dramatic easing in financial conditions, and we haven't really got going yet.
That's right. So that's why, again, this is why we wanted to put this out, because it's kind of all, coming together, and with so much noise. Right?
But Julian, what does this start to mean for markets? Because markets are getting utterly terrified and are creating inflation narratives, recession narratives, broken business cycle narratives. What is the markets telling us right now?
Sentiment and positioning. If we talk, first of all, let's just go back to the chart I posted on X. I'm not going to skip all the way back up, but you guys will have access to this deck. But essentially, if we look at the 3-month rate of change versus either the NASDAQ, the S&P 500, or Bitcoin prices against our financial conditions index, which is obviously advanced and inverted, we've priced in all of the Q4 tightening in financial conditions, and now financial conditions are easing. So the expectation here is that now that markets, if we look at this, are extremely oversold. So if we look at the S&P 500, the percentage of stocks trading with a 14-day RSI below 30 being oversold is at almost 50%. And by the way, the markets, well, I don't have my Bloomberg open, but at the time we were recording this, the market was rallying back, but this does not take into account today's move, whatever that is. Okay, this is yesterday, or this will be Friday's close. So we saw, a move up to 50%, which is the most since Q4 of 2022, when Raul and I were writing that article, The Turn is Near. And before that, COVID, like when the economy, the entire world economy shut down. Then you look at the NASDAQ and you're like, oh, right, highest since COVID. Okay. A very different environment, obviously. And then if we just look at a series of other measures, if we look at the percentage of stocks trading above the 50-day moving average, oversold, 200-day moving average, oversold. This is the NASDAQ. If we look at the S&P 500, the percentages of members with new 50-week lows at nearly 30%, Q4 of 2022. Same thing with the NASDAQ. And then when we talk about investor sentiment, back in early March, the AAII survey showed a surge to 60% of investors surveying that they were bearish. And that's only happened 5 other times, looking back to survey inception back in 1987 or so. And then if we just look at what happened last week on prices moving lower again, we saw a spike to 62%, which means that investors, according to this survey, are as bearish as they were in March of 2009, or that was the last time we saw a push above or to 62%. And by the way, so that was the global financial crisis, excuse me, and March 2009 was the low for the market. And then if we look at the Conference Board survey, so 44.5% of consumers currently expect the stock prices to decline over the next 12 months, and that's the highest since July of 2022, and before that, October 2011. So the point here, and I'm going to show you a couple more of these, if you don't think that we're heading for a 2008 style entrenched global recession, which is not our view, these are incredible data points to take a more contrarian
Don't forget,
view.
The 2008, what was different is that was a collateral crisis. That was before QE was used to stop collateral falling in value. So that was a full-on debt deflation that was stopped via the printing of money, the debasement of currency, which lowers the value of the denominator and optically makes assets rise. Once you do that, you stop the risk of a collateral crisis, which stops a debt crisis. You pay for it via debasement of currency, but it's a slower mechanism than losing 75% of the value of stocks.
Correct. So again, this is a very different environment to back then. And if we look at some of the other surveys I've just pulled together, if you look at the Bank of America Fund Manager Survey, so that's at the top left, we saw the largest drop in U.S. equity allocation on record in March. According to the Allianz survey, 51% of respondents are expecting another big market crash on the horizon. And then if we look at the fear greed index, which unbelievable, and again, this is yesterday. This will have been from Friday, I believe. It's an extreme reading of 4, and then that's like, and then the Renaissance macro long short exposure chart just in the middle there at the bottom shows the largest short position in over a decade. So again, gives you an idea of where the market is sentiment wise. And then when we look at Bitcoin, so I think this is a great chart. This is Bitcoin, and then its 14-day RSI. When we fell below 30, is that it's not unusual if you look back at the previous 3 times Bitcoin triggered an oversold reading to base, and this base can take time. And in both the 2022 instance and the 2023 instance and the 2024 instance, we made lower lows. And if we look at intraday pricing overnight, we made a slight lower low versus the lower low which occurred, the low which occurred last month. But again, I believe we're in the process of this basing. So the kind of this accumulation phase. And then if we look at the last 3 times, so that would be the teal line, so the average price trajectory following the last 3 Bitcoin RSI oversold readings. And again, oversold means below 30. This is the current trajectory versus the future trajectory. So what you can see is I'm looking back 2 months and then forward 4 months. If we just look at when things start to pick up, it's really a month and a half after the original oversold reading is triggered. So these bases take time. And so the chop that we're seeing
phase is very strong.
That's strong. Right. And so what's been frustrating over this phase is the chop. And I can see all over Twitter, and we've talked about this before, people are like, oh, well, Bitcoin's down another 2%. No, it's down another whatever. It's not. It's just been doing this. And so, it's been going up, whatever, 10%, and down 10%. But we made a new low intraday last night, which we've already recovered. But
and
the point
is normal for alts, and it's normal for alts to bleed in that environment, generally because there's more issuance of alts, and generally as people pull in from the risk curve, alts come lower, but they come back faster, which is that alt season chart we talked about before. I know nobody believes in it now. There's too many altcoins. It's all fucked. It's only Bitcoin dominance forever. It will most likely, probabilistically speaking, play out like it's always played out, which is as the ISM rallies through 50, this recovers. What happens is alts outperform.
That's right. And the only other thing I'm just going to say on the business cycle, and then we can get to technicals, is really with break evens now falling and the dollar lower and rates lower, plus city economic surprises. If we talk about the U.S. basing and moving higher, really that's an environment of what Raoul and I classify as macro spring. So people are looking at the ISM report and saying it's stagflation. The report was stagflation driven by what happened in Q4. Again, so it's backward looking. Whereas if you look at financial conditions and that being paving the way for better growth, better economic surprises, going forward into the next several months, plus, as I say, market implied inflation expectations dropping. Once the market settles, which is what we're going to talk about now with technicals, this is actually more conducive of macro spring, so a disinflationary boom than stagflation or macro fall. Okay, so let's talk about the technicals.
This is what's getting me very excited, is when you go from the very big picture, which is where we started, you then zoom in on the business cycle and the liquidity cycle and market sentiment, and it matches the technicals. It makes you and I get very, very interested in the opportunity going forwards and the risk return. And that's the key thing of this whole presentation, is the fear is overextended.
Okay. And Raoul, you and I talk about this all the time, but another reason we wanted to put this presentation together and show you how many angles we're coming at this from. It's not just macro, it's not just the Trump 2017 cycle and our conviction for a weaker dollar. It's the technicals, it's the sentiment. We're trying to put it all together because what I've always tried to do as an investor is, and the best you can do, is reduce as much uncertainty as possible before making an investment decision. That's what we're trying to do here, coming at it from all the different angles. So, the chart's up. So the first chart is just Bitcoin within its log regression channel. And if we look at again, that moment in time in Q4 of 2022 when Raoul and I turned bullish. We're now 2 standard deviations oversold within the log trend. So pretty much an opposite signal to what we saw in kind of Feb, March of last year. And then when we look at the DMARC counts, okay, just today, we triggered a 13 daily buy. And if you look back in time, both into 2024 and also, let's say, December of last year, these 13s work pretty well. But where DMARC indicators become even more powerful is when you have the daily and the weekly stuff, stacking up. And so now we've also got a 9 weekly buy setup, where again the 9s have worked well in the past. And with Solana, we've got this cluster of 13s. At the low here, very similar to what we had in Q4 kind of last year. And I don't know, what is this, Raul? A 9, 9...
9, 13, 13, 13, 9 or something stupid.
So it, again, looks very similar to what we saw last year.
It had a similar kind of cluster of 9s and 13s.
That's what I just said.
Yeah, and then the bottom is the same.
This was taken before the open, or was this taken? No, this is after the open. But currently we're on day 7 of 9 lower. So Raul and I were talking about this today. We want if the market does kind of nothing here and muddles around over the next couple of days, we'll still be able to trigger a 9 buy. What we don't really want is a sharp rebound here that then removes the count. We would really like this to count down to a 9. And then if we look at the weekly setup on the NASDAQ, it's on week 8 of 9 lower. And so
it's almost impossible that won't be a weekly 9 next week.
Yeah, nothing good happens below the 200-day moving average. It's like, really? I mean, if you are of the view that we're not at the end of the cycle, okay, then if we look at post 2008 period, there was, 5, no, call it 6. You can see one I didn't even highlight there, moves below the 200-day moving average, which created fantastic, buying opportunities to add. And so once again, we're just not of the view that the cycle's over. And so we're seeing this more as a buying opportunity. And then when we look at the VIX, very similar counts, right? And this is pretty remarkable, the spike that we've seen in the VIX, because it's as high as we saw during the yen carry trade unwind on August 5th of last year. And before that, once again, when the world shut down during COVID. So here we're on day, as I say, 7 of 9 higher. And then the weekly, once again, counting up into a 9, where the last time we saw a 9 sell on the VIX came during COVID. So the question you're all here for is the banana zone canceled? The answer is, in our view, no. First of all, just to, we have seen over the last 2.5 years, 7, 20 to 30% pullbacks in Bitcoin. And while you're feeling this current one, because we're still in it at the moment, you probably don't remember any of the other ones that we saw, over the course of Q1. We're still up 400% off the low. So you don't remember these things once they come to pass.
And also what's interesting about that chart is, okay, so the correction is in line with expectations. Then again, you've got the big picture macro, the business cycle, the liquidity analysis, the sentiment analysis, and the technical analysis, all telling you that maybe everybody is over-fearing and that the upside projections are the probabilities are for upside as opposed to downside.
Well, and as I had pointed out within the business cycle section, Bitcoin's already priced in an ISM of around 47, okay? And if that's right, based on the move that we've just seen, but as we've been highlighting, financial conditions are now easing, which means that over the next 3 months, the data should start to improve. And then when we look at the 2017 cycle, so the cycle that Raul and I feel based on our views around the dollar and liquidity turning higher, we saw 2 30% corrections, 1 35% correction, and 2 40% corrections over the course of that year, right?
And however, also with that is the cycle didn't get going because we had the same tightening of financial conditions in Q4 2016.
Yep.
The cycle didn't actually get going till the end of April. and then it accelerated. And again,
Yeah.
it's very similar to us is where we are today.
But then off that low point, over the course of that year, despite the 5 or so corrections I just mentioned, 2 of which were 40%, Bitcoin went on to 23x that year. And no, I say this all the time, we're not expecting 23x. What I'm just trying to set for you is the framework for understanding, where we are and why we still think the best is to come. And we've pretty much closed the gap with global M2 using the more correct. And so what this would suggest, if we're right here and everything that we just outlined, is that Bitcoin should be putting in new all-time highs, or at least hovering around all-time highs by the end of June. And the same is true for the NASDAQ, which has grossly undershot.
But again, once China's deal is agreed, and the ugliness of the negotiation, let's see how that goes. But once that is agreed, there is a big gap versus what liquidity is doing, and we will have a very fast snapback, I think.
Yeah, I totally agree. I think it'll be, once we get the DMARC count stacking up, I think it's going to be a pretty V-shaped move.
Yeah, and that comes next week. By Wednesday, if it continues to count as it does, and then next week should confirm a weekly 9 as well. So again, it is, opportunistically speaking, incredible time.
Nowhere near the conditions for kind of a late cycle peak as we've seen historically. If we're looking at our GMI cycle top finder, we don't think that the banana zone is canceled. The banana zone, and some people have asked me, were you too early on that? Well, no, because in Q4 of last year, when Bitcoin was at 56,000, we said, here we go, we're going. We're still at, what are we trading at right now? 80. You can't get returns like that. But the most important point here is that we're still within this upcycle. It's just that these corrective phases.
And look how similar, again, go back, how similar that 2017 cycle was. That kind of weird double correction it had. It's very similar in price, time, structure. And the next phase is the next phase of the banana zone, which nobody believes. You get trolled on Twitter all day. Banana zone cancelled. Look at the fucking chart. Does this look like banana zone's cancelled? Or are you just impatient? And I just think people are just goddamn impatient. We build from the very big picture down to the very short term. We're getting to an incredibly interesting by the fucking dip moment. But hopefully you can understand that nothing happening here is out of the ordinary apart from the peak fear narrative. Sentiment is wildly overdone here. And don't forget, coming out of we're going to tariff everybody a gazillion % will be the walk back, the discussions, the negotiations, the agreements, and all of that will take uncertainty out of the market. So on a forward-looking basis, ignore all the work that we've just done. Is there likely to be less uncertainty or more uncertainty in a month's time? It is almost 100% likely to be less uncertainty. Markets hate uncertainty more than anything else. They overshoot when they're trying to price uncertainty, and then they'll price in the outcomes. This is where we are. We're in a time that is almost as peak fear as COVID was. It's similar to 2018 when the Fed pivoted. These kind of things, even 2008, these things don't come often. But when they come, they're a goddamn fucking gift.